Hey everyone, welcome to another episode of the Adventures of a Real Estate Investor. I'm Susie.
Now, I'm Michael, and we're excited you joined us for this adventure.
So today we have a guest who has as much energy as I do, which you don't match very often. So I'm super excited. I am super excited to have Charles Dobens with us today. Thank you so much for joining us.
Oh, my pleasure. My pleasure. You two are adorable. I said, you guys are adorable. You guys are adorable. Oh man, this is gonna be fun. This is gonna be fun.
It is.
You guys are in for a treat. Absolutely, 100%. Yep. So to kick everything off, Charles, would you mind sharing with our adventurous family, a little bit about your background and why you started investing in real estate?
Yeah.
Sure. So my background is originally I like to tell a story. It's sales and marketing, insurance agent out of college. Hated it. I tried to follow my father's footsteps, couldn't do it. I went back to law school, got my law degree, and I started a company more entrepreneurial than legal. And I started as a benefits administration company. Worst business in the world you could ever be in.
Good.
40 years old, said, I can't do this anymore. Went to my wife, said, I'm going to be dying early death. I got to get out of this business. And she said, what do you want to do? I said, I've always wanted to own apartments ever since I was a young kid. That was where the money, I knew all the wealthy people in my town owned apartments. I said, that's what I want to do. And she says, okay, let's do it. So I sold, the story about burning the bridges or burning the ships. I sold the business. I never looked back, and I started buying apartments. That was back in about 2005, 2006. And so I've been in this business quite a while. And now I teach people how to do it the right ways and own enough properties of my own. But that's where my fun is. That's where I'm no longer that guy that hates Sunday nights. I come running into the office every day, and I absolutely love it. And, my clients talk directly to me. They're like, wow, I can't believe I speak to you. I said, I don't want you to talk to anybody else. Why should I give that fun to somebody else? I'm enjoying it. So that's what I do now. And it's just such a blast. Every day is a great day.
That's awesome. I love that.
Yeah. And don't worry, it's going to happen to you guys too. I mean, listen, I'm amazed at how many of my students are now teaching other people. They're all starting their own mentoring program. And there is no greater compliment in the world to me than that. And it's really very flattering. Yeah.
That's cool. I love teaching too. I've taught university level, and I really enjoy teaching. So I'm looking forward.
Oh, that's easy though. University level. Come on, you got tenure. You don't have to hard, My brother's a college professor, and he talks to me more about Bill Burke podcasts. And I said, Lenny, how can you listen to all that many podcasts? He goes, I'm a professor. I don't really work all that hard. I'm like, so yeah.
That's funny.
Yeah. So
don't tell too many people that.
Exactly. Yep. Especially your wife. Don't let your wife know.
That's funny.
How easy it is. So
how was 2008 for you?
2008 was a nightmare. It was a bloodbath. I'll never forget when my world changed. It came about, we heard the news that Fannie and Freddie had filed bankruptcy, and everyone kind of looked at each other like, okay, what does that mean? And what happened was the next day, my mortgage broker called me up and said, we had a deal about to close with Key Bank. And he called us up and says, Key Bank is just pulled out. And I said, what do you mean they just pulled out? They gave us a commitment. We're going to close in 30 days. He goes, no, they're getting out of the business altogether. And that was like when it first hit you. And I'll tell you, probably should have, packed up ship and not closed that deal. But, we're all looking at it like, oh, we don't know what's going to happen in the world in the next couple of years. So we found another bank, and it was Walker Dunlop, and they were absolutely the class act of dust lenders. And we closed the deal with them, and then proceeded to struggle for the next 4 to 5 years, keeping, never missed a payment, never missed anything, but the values the cap rates went up and the values came down. And if we had a short-term loan, we were in trouble. And the ones that we had more 7 or 10 year term paper, we were able to salvage. But some of them, we had to drop our keys on the bank's desk and shake hands and part friends. And that's what happened. And it's going on right now too.
Yeah.
I know. I don't know if you know Ashley Wilson. She's a good friend of mine. She was one of my students as well. And she just put out a TikTok that something to the effect about people who purchased multifamily property in 2022 are really hurting right now. And a comment said, please explain what you mean by this. And my response back was, if you know, you know. Yeah, that's exactly what happened. And that it's going to start happening now. And it's too bad. We kind of warned people about it. I did. I was on that multifamily shark pool a couple of times watching these silly, ridiculous deals being bandied about as like the best thing since sliced bread. And I was like, no, this thing's gonna die. Don't get in this deal. You'll regret it 5 years from now. So, but it's an opportunity. I was on the wrong side of it last time. I'm on the right side of it this time, and I'm going to take advantage of it. So, yeah.
I appreciate it. Thanks for the information on that, and thanks for explaining everything. Like, I think, the biggest takeaway, what you kind of mentioned was like, perhaps the biggest takeaway and like lesson learned from 2008, which should be carrying forward to right now.
Yeah.
Long-term fixed rate debt is the way to go, right?
Yeah, no, or even, I just had Brian Burke on my podcast, and great guy, just brilliant when it comes to multifamily. And he does floating rate long-term. And one of the reasons that's beneficial is that he's able to sell the property during that 10-year term without suffering any prepayment penalties, any a defeasance or a yield maintenance costs, which is a great thought. But he is all about long term, and I tell you, I'm totally agree with him. That's what I learned last time. Those people who took out bridge debt in the last couple of years, they are scared to death right now, and it's really the long term. And I'll tell you another thing. Paul Moore. I don't know if you know Paul Moore. He's a great guest of mine. He wrote a blog post for Bigger Pockets, and he just succinctly explained why we as true real estate investors don't care what the market's doing. The market's going to go up. The market's going to go down. We buy value. And we know as managers and owners of properties how to unlock value. And because of that, that's we interest rates go up. Okay, interest rates go up. But if you unlock $300 per unit of new rent money, that overcomes all ills of the market. Easily overcomes all ills. And that's what we're seeing now. And with COVID, what happened with COVID, you saw a lot of people a couple of years back just trying to hold on and not go up on the rents because they didn't want to lose the occupancy. And now they're looking to get out. And now the rents have skyrocketed. And now we're seeing a lot of properties that have built-in value because of COVID. And and you're not seeing those on the bigger properties. You're seeing those on the mom and pop properties. And that's what we're focusing on now too.
Love that.
Yeah.
Yeah. Susie and I are huge proponents of long-term debt, and we usually we like fixed, but we also do some kind of step down prepayment, right? So like we can in 5 years whatever exit it with 1% or something like that. And we don't.
Well, that's good. I'm glad that you guys figured that out early. It took me years to figure that out.
We had a great mentor. Yeah.
And also, I mean, it's just you learn the hard way, because I had multiple, at the time, what difference did it make? Everything was going up, and no, I'll just do 5 years. We'll sell it. We'll get something else. And no, you lose a lot of options when you go with a short-term debt that you really, as a smart business person, you need to leave those options open. I mean, the whole thing about business and owning a business is it involves risk. And the most successful business people are the ones that are able to mitigate risk and make sure that they cover any mistakes that could possibly happen. And the ones that just think, hey, the sky's just going to keep going up, rents are going to keep going up 20% per year. If that doesn't happen, their model fails. And that's a scary place to be. So,
yeah.
So then are you team fixed or are you team variable?
No, I'm actually, right now with fixed, I guess I'm team long-term.
Yeah.
I'm team, but I can't really, I'd have to really look at the numbers to figure out which one, where things are going. I mean, look at Jerome, I call him Jerry because he and I are tight. He just came out with his interest rates going up again. And he does not have inflation under control, it's going to keep going up. So, we're in a situation right now where at some point, well, first up, what's happening right now is that the owners haven't caught on. That's the problem. The owners are still like thinking that their babies are beautiful and that this is not going to turn around anytime soon. And we all know that's not true. We've been through it before. So, and the beautiful thing about termed debt is it forces the market to change, because sooner or later that term is going to end. And at that point, that seller has no option but to sell that property at what are then market rates, or he'll lose the property. So it's part of the beauty of the ballet of multifamily numbers, how everything just is a perfect match, and everything ties together. So I'm gabbing. I'm just going on.
No, you're not. No, yeah, it is good stuff.
Yeah. No, but it's such an exciting business to be in. It is the greatest business in the world, and don't think that this is a get rich quick scheme. This is a long-term business that you will be able to leave your children and their children and have them live lifestyles like that you could never have imagined before, all because of multifamily. And it can be started quickly, finger quotations quickly, but if you do everything I tell you to do, you'll be done in 5 years and you'll be set for life. Your life will be easy.
Yeah, because quickly also is determined by if the market's hot or not, right? Because like we were saying with market cycles, like it all just depends, right? But it's like staying in it while it's cold or whatever verbiage you want to use is the important time too. Because then you have a pulse on everything that's going on, right? Because if you start to notice when everybody else notices, that's when you've lost all the good deals.
Exactly. If everybody else is doing it, that's when Warren Buffett doesn't do it.
Mm-hmm.
And we've just come through a period where everything was going up. I mean, some people would buy a property and 2 years later they'd sell it because the market had just gone up so fast. They'd take your money, your chips off the table. It was crazy. And everybody thought, now's the time to get into it. Now's the time to get it. No, now is the time to get into it, because now is the time when things are starting to really crack open, so to speak. I mean, I talked to so many investors that over the last 5 years that said, I can't find a deal. And the correct answer was, then don't buy.
Mm-hmm.
Don't buy. We're not here just to buy for the sake of buying. Just wait for a deal. Be patient. I mean, that was what Warren Buffett always talks about, is the character of a good investor is somebody who's just very patient and will wait it out. And he's absolutely right. And now those people that have waited it out, they know what value is, they know how to get it, and their powder is dry, and they're ready to go after it. So it's a good time. It's a very good time. So yeah.
Yeah, I think it's also an important time. I guess what I'm trying to say is, like, I think during times like this, where there's a cooling in the market cycle and stuff like that, is where asset managers really shine, right? Like people who actually understand how to asset manage to add this value that we talked about, right? Uncracking that value and actually adding it versus just buying in a hot market and then selling 18 months later just because the price per door went up 50K, right? So it's like,
exactly.
I think,
that always goes to buying it right. And it means finding the value early on and then staying with the plan, staying with the strategy. Because I see so many people that run out of money.
Mm-hmm.
They run out of money because they didn't, they thought, first off, the biggest mistake I see new investors making is thinking that they can do a value add deal using current cash flow. And if the occupancy goes down, there goes their budget for all the rehabs that they were gonna do. I mean, the easiest time to raise money is before you buy the property. Toughest time is after you buy it. So raise all the money first, then get in there and do that value add as fast as you possibly can, and then get out. That's the part, for a lot of my students come to me from the fix and flip world, and they want to get into the cash flow business. And I teach them about value add. That's the best time, best way to get in there and really make a ton of money. But bring your expertise from the fix and flip world of speed and get in there as quickly as you can. And it's all about the velocity of money. The faster you can get that thing turned around, the better off you're going to be. And you need money to do that. Mm-hmm. I mean, this is a business. All business requires cash. As soon as a business is out of cash, it's out of business. I had, the first the first chink in the armor that I heard, I watched happen was a student of mine called me up. He said, Charlie, I just got a phone call on a deal that I did a 1031 exchange into, and the guy's getting foreclosed on. And this was within the first 90 days of the COVID shutdown. And what happened was the government gave all of the multifamily owners, 90 days rent, boost, and then if you could show it, you could get another 90 days. And this guy showed 90 days, and he got the 90 days, and then he went back for another 90, and even the government said, no, we're not going to fund your deal. It was that bad of a deal. And so my student calls me up and says, what, I can't understand this. We just got a shot in the arm, and they're not going to give him another 90 days. And I looked at the deal and I said, I know exactly what happened here. This guy went into this business without enough cash. They thought he could do the rehabs with current cash flow, and he's run out of money. And I called him up and I talked to the guy, and I told him, this is what's going to happen. He says, can you help me? I am helping you. I'm telling you what's going to happen. So
Right.
just be ready. There's nothing else that's going to happen. That's why I got into this side of the business, because I was representing clients, friends of mine who were losing their properties back during 2008, 2009. There was nothing I could do for them. Just hold their hand through the process.
Yeah.
Then I went back to him. I said, why'd you buy that place in the first place? He said, oh, well, I was going to do this and I was going to do that. I said, that was never going to happen. You were taught the wrong way on how to do this business. And I need to get in there and start teaching the right way on how to make these things happen. So that was the first time I ever saw a guy lose a property post-COVID. And now it's going to happen even more as we go on. So, the banks are going to make it happen too.
Yeah. I mean, not to only talk about raising capital, but raising capital is difficult, with single family homes or a duplex or even a quadplex, you can raise that money from your own bank account and not have to worry about anyone. But to think that you can potentially do that with multifamily, is it doesn't work well unless you've done a super great sensitivity analysis and your break even occupancy is 30%. But I haven't seen a property like that yet.
Not at all. No seller would give away a property with that type of a break.
Yeah. Right.
Yeah. And if you do find them, let me know. But I don't think you'd be able to sign the contract, because the guy is obviously not of sound mind.
Yeah. I'm the
right
power
back.
of attorney.
Yeah. Get a good title insurance policy on that one, because you'll lose that one. But I had that conversation yesterday for the first time. First time I've heard that conversation in a long time was that it's getting harder to raise money now than it was before. I mean, during COVID, everybody was flush with cash. Now it's getting a lot harder, and that's the name of the game. And what Brian Burke was mentioning on the podcast about the 3 circles of trust that every investor needs to close with every investor. Every sponsor needs to close with every investor in order before they give them money. That's trust in real estate, trust in the deal, and trust in you. And if you are just now starting to close those 3 circles and you just got the deal under contract, you're too late. It's not going to happen. You got to work every single day towards building that trust with your investors.
Yeah, it's taken years for Susie and I to build that trust, right? So and people, it takes time. It just takes time. That's it,
And I'll tell you,
proven track record, show time and time again that you can actually asset manage, complete the business plan.
Yeah.
Continue to, increase the value of the property. Yeah. It's just.
And I'll tell you, one of the best things that I learned back during the last crash was, when your investors call, always answer the phone.
Yeah.
People that didn't answer the phone are no longer in business right now. And I worked with a lot of them, and they're gone now because you just got to tell your investor, sorry, we're going to lose the property, and there's nothing more I can tell you. But I'll make it up to you somehow, or thank you so much, and I'm losing my shirt too. So all of those types of things, you got to be able to have those tough conversations. And I'm telling you right now, there are a lot of people who got into this business over the last 5 years that are not answering their phones right now because they're seeing what's going on with the cap rates, and their notes are coming due, and they're in trouble. Mm-hmm. Answer your phone.
Yeah, 100%. I think that's very important. Just being available, number one, as an operator, and then just being able, or continue to provide, updates. We do monthly to our investors, and I think that's important. I know a lot of people who went to like weekly updates during COVID, right? When people were like, when things started shutting down, I heard some operators move to, weekly updates and just
Let's not get overboard there, Michael. Let's not do weekly updates. That's like doing
it was like a full update,
distribution.
but just like, hey, this is kind of what's going on, so
Yeah.
absolutely.
So, but it's a this interest rate thing is going to keep climbing, and it just keeps, those people that had those longer term loans are going to start feeling it more and more as that period comes up. What's interesting though is I did if you go on distresspro.com, they have some great analysis of delinquent loans, all different types of loans in different markets, and multifamily delinquent loans are the lowest out of all of them. Yeah. So it hasn't come yet, but I was at the distressed loan workout and distressed asset officer conference in Florida about a month back, and they were saying it's coming, get ready for it. And they were saying it's going to hit the credit unions first, because the credit unions were incredibly aggressive with some of their lending, and they do not have the ability to raise capital the way that a typical bank, a state chartered or nationally chartered bank does. And that's going to result in a lot more foreclosures within credit unions. And that means that what you need to do is you go to a company like Bauer Financial, like the ice skate, bauerfinancial.com, and find those local credit unions in your marketplace. Or distressedpro.com also has a good list. And you can go in there and you can find those banks that and start building up a relationship. Don't forget talking to the brokers. Forget talking to the brokers, because the brokers are going to be serving me my gin and tonics down to the country club next week. Go talk to the bankers. The bankers are the ones that are bringing back the assets, and they're the ones that are going to be looking to sell the properties. So start building a relationship with the bankers.
Love it.
Yeah.
Great advice for sure. I want to kind of dial back on 2008 as well. Obviously, you shared a lesson learned there. Do you have any other? You just close out that piece there. I just wanted to ask if you had any lessons learned from 2008 that now you're applying to kind of what we're seeing now. I mean, it's not. This is nothing like 2008, but it's still a cooling of the market and everything like that.
Cool.
Yeah. Okay. So what was really different between 2008 and now is 2008 was a crash. It was a crash. We watched the crash happen. I wonder what it was like back in 1929. If it was the same way, where it was like instantaneous, overnight, boom, everything pretty much, you got Fannie and Freddie closing down, all the GSEs are shutting down, all the big Wall Street banks are filing for bankruptcy, everything's crashing. That happened in 2008. We're going to have a downturn in the real estate cycle. It's already begun. It's starting over the west on the coast, California, like it did last time. It's coming this way, but it's not going to be a crash. It's going to be a turn, and the market is turning. And what's that means is the turn is going to be different in different markets, and it's going to be turning at a different rate. So, for instance, those markets that spiked the highest are the ones going to crash the most. We're already seeing it in the Boise, the Phoenix, the Austin, all those areas. They're gonna dive the most. You go into those secondary and tertiary markets in the Midwest that are slow and steady, and those are not going to have as big a downturn as the other markets. So different areas are going to withstand this crash, this turn better than other areas. So that's the thing you need to keep in mind when you're looking at different markets. Nevertheless, those interest rates are always going to impact the ability to borrow, and that ultimately will impact the price. The owners right now do not believe that to be true, because if you figure out how do you determine the valuation of a property, it's a cap rate. It's the NOI divided by the cap rate. Nowhere in that formula is interest rates. But now we have to talk about cash on cash return. Now the investors have to get a certain cash on cash return, but because of the cost of the money, that's the next thing that is going to change, and that's going to impact the value of the property. And that's when you're going to start to see cap rates change. And so so that is what's going on right now in the marketplace. But it's all good. It's all good. It shakes things out. It keeps money moving, and that's what ultimately creates a strong economy.
Charles, we had people ask us, 3 years ago, why are you investing in Tulsa? You know, they kept asking us why Tulsa, Phoenix, Austin, you know, all these other places, Atlanta, they're on
Didn't I
fire.
tell you?
Why are you not there? And
Didn't I?
trust me,
Didn't I ask you? I didn't I ask you why you invested in Tulsa? What do you love, mansard roofs?
Yeah.
you did ask that, yeah.
And we do.
I did.
Yeah, we do.
We know
Yes, we do.
what to do to change the mansard roofs.
Yeah.
Okay, well, let me tell you something. I have one student. So when somebody comes into my program, I teach them about markets, and they watch training videos, great training videos on identifying your market and being able to sell your market to your potential investors. And I just had a student come to me and said, Oklahoma City, Tulsa, this is where I want to invest. I said, okay, sell me on it.
I'm just kidding.
What? No, it was. Yeah, I'll give you your name.
No. I was just joking. I said, tell him no, but it was just.
No. No, you want more money coming in there. You want more money coming in.
No, but then what happened?
Oh, he just nailed it. The guy sold me on Oklahoma City. Now, the problem is that, okay, so once he sells me on it, then I said, okay, now we have to identify 1,000 properties in that market that meet your criteria. And so his criteria was 1980s newer, 10 to 100 units. So we go on CoStar, we pull down all the reports, and we're looking at maybe 350 once you go to Tulsa, Oklahoma City, Lawton, all those areas. And it's we're now having to go to the panhandle of Texas to try to find more properties to have 1,000 properties to start going after that meet his criteria. So there aren't a whole lot of opportunities, in that realm. So, but it's a good market. And I have another student that is actually selling 2 properties in Oklahoma right now, and he's done very well with both of them. So, and he's done nothing to them, and he's done very well by just holding them. So so that's perfect example of a place that's just going to be slow and steady. And but the other thing too is Lawton has a military installation there, and that's helping out that city as well. So yeah, you guys just proved my point. Perfect example, Tulsa. Yep, Oklahoma.
Yeah, I mean, but then that is also too like a great example of like needing to make sure you build those relationships, with brokers, lenders, and everyone, because you need to be able to strategically, submit LOIs to where you stand out. It's not just like the highest bidder. It's like, what relationships have you formed?
Yeah.
We learned that. Yeah. Tulsa is a very relationship based.
Yeah.
Yeah.
And now the thing is, what you need to do is you need to start talking to local lenders down there, because that's how one of my students got a deal. And those local lenders, they're like good old boys. It's not like you're dealing with a big Wall Street white shoot firm. These guys will get down and talk to you and make things happen. So that's that's definitely something to think about.
Absolutely. Yeah, Susie has spent months and months and months in Tulsa, getting to know vendors and
becoming best friends.
Yeah.
Gosh, you are such a romantic guy. Like, you're taking her all to the hot spots, aren't you?
I went all by myself.
Tulsa is actually a really cool city. Downtown is amazing.
Well, actually, and to add to that though, that's what true asset managers have to do. Like if you have to go to the city, because we were living in England. It's not like it was a drive away. Like that's what you have to do. That's what you have to do.
Yeah. Where are you guys now?
Dayton, Ohio.
Yeah,
you're in Dayton?
Yeah.
Oh, before we hang, I got to talk to you about Dayton.
Well, we can get there soon, but
okay.
We have 4 adventurous questions we have to ask you.
Oh no. Okay, here we go.
We ask all of our guests.
All right.
It was a great transition into it. Your conversation was great. People will learn a lot from this. So if you are still listening, which you will be, please rewind and listen to it again. Because no, seriously, there was
a really good conversation.
Yeah, it was a really good conversation. Do not listen to this one on 2X.
2X.
You gotta be like, blah, 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 blah. But this is not the
especially
one.
with my New England accents. I talk fast. You people from Ohio.
That's funny.
My college roommate was from Cincinnati. I thought he talked like slow and steady like this. I thought it was because he was stoned all the time. But then I went to Ohio, I went to Cincinnati. I found out they all talk like that.
You go even further south, they talk even slow, or
yeah, exactly. Like I would go down to Lexington, and it was just the same way. The horse talked faster than the people in Lexington.
That's funny.
Hopefully we're not offending any of our adventurous
I don't care who I offend.
I'm from the deep south, Charles. So And I
Wait,
work
where are you from?
just outside of Atlanta. So,
Oh, okay. Yeah, yeah.
so.
Where are you from, Susie?
I'm gonna claim California today.
She's one of those army brats or something.
No, no,
No,
no.
you're
I
saying
was born there.
California?
I was born there. Yeah.
All right. Yeah. All right.
California's
Yeah. All right.
It is.
You won't say where. So, all right. So, what are my adventurous
Are you
questions?
ready? Are you ready for that?
Go ahead. Go ahead.
All right.
Okay.
So the first question we have for you, Charles, is where is one place you wish to travel to and why? Dayton, Ohio.
Oh,
Nice.
that's cool.
I already have it open on my thing. I ran a half marathon there back in 2016, which is really bad because I still have this shirt and I wear it around the Nashville YMCA all the time, and people are like, oh, that shirt's been around since 2016. That's pretty gross. It didn't like dawn on me. So I got to go back to Dingle Peninsula. Absolutely loved it, and I've been telling everybody that I want to like go someplace for a month and just live someplace, and nobody knows where I am. I'm just going to run my business from there and, see how it goes. I know you guys did it when last time I talked to you. I don't know if you were Italy or England last time I talked to you, but you did it, and I'm going to do it too. So there's your answer. Dingle Peninsula.
Love it.
I can't wait to look it up.
Yeah, I'm gonna look it up when we get
off. It's gorgeous. Absolutely gorgeous. Breathtaking.
That's cool.
Breathtaking. I think the movie Leap Year, the rom-com Leap Year, was filmed there.
That's
so
cool.
yeah.
Thanks for that.
There we go.
Yeah.
So then, question number 2.
Okay.
What is one thing on your bucket list, and how are you leveraging real estate investing to achieve it?
Oh man, one thing on my bucket list. Boy, I tell you, I've been knocking things off my bucket list, like getting my pilot's license, bought the Porsche. Well, okay, so there, I got the Porsche. How about that one? I got the Porsche, and that was definitely because of real estate investing. Absolutely. Yep. Yeah.
100%.
That's funny. You're like,
okay.
How many more things should I add? This is fabulous.
Here's the thing is I bought the Porsche Panamera, the 4-door, because I still don't couldn't quite make the break going for the 911. I said, I still have to, be able to fit the whole family in the car, and I'll still. Oh boy, it's still fast. It's still fast. So
that's fun. That's
cool. At the race, our Tesla.
Yep.
Porsche. There you go.
Oh my God. I was going down the highway the other day. And I was scrolling, and this guy in a Tesla just starts toying with me, like, because he just goes, he finally takes me, and I just give him the old peace out sign, like, peace, brother, you win. So yeah.
That's fabulous.
I know, because I remember I had that. My son is a huge Top Gear guy. He's watched every episode of Top Gear. And so he knows everything about cars. And then I said to him, Sam, somebody said that the Tesla can beat out like a Porsche or anything. Oh yeah, I can. Yeah. I said, no, it's just, Dad, watch this episode of Top Gear. And so they did the whole race. It was amazing.
That's cool.
Absolutely amazing. It was really cool. Yep.
Oh, cool. I didn't know that.
Yeah, go find that episode. Go find that episode on Top Gear, and where they're racing all the top fastest cars in the world against a Tesla on a runway. That's how they did all their races, on a runway. Yeah, go check it out.
The Tower Watch list. Yeah, thanks.
Yeah.
So the third question we have for you is, what is one piece of advice for someone who wants to start passively investing in real estate?
Oh, you got to make sure you understand the sponsor, because you make sure the sponsor is of such a character that they will answer your phone when the going gets tough. That is really key. Not all sponsors are created equally, and you've got to make sure that the most important thing is the sponsor. At that conference that I just mentioned about the loan workout and the distressed assets, all the bankers that get up there were saying, all we do is evaluate the sponsor, especially when things are turning. All we do is evaluate the sponsor. And then one thing I didn't mention, I forgot, was that cap rates are becoming secondary right now to any evaluation on valuation. All the bankers are looking at is really the debt coverage ratio and property support, the deal, and the sponsor. So they always, the sponsor is key. So that's the answer to that question, hands down.
Well, thank you for that. That's important.
I totally agree with that.
Yeah.
So then our fourth and final question is.
Oh, I thought there was 3. Okay, good. Okay.
You have one more. If you had unlimited resources available to you, how would you leave an impact?
Unlimited resources? Oh, okay. All right. I'm already doing it right now.
I love it.
Yeah. So my father was an orphan, the greatest man in the world. And he was lived up in, was an orphanage until he turned 16. And then he got aged out of the orphanage, came back to live in Nashville with his alcoholic father and his older brother in a one room hotel where his father was a night manager. And, he was 16 years old. And then when he, by the time he graduated from high school 3 years later, he was class president and most popular boy. And, I said, how did you do it, Dad? As well, I just had, great teachers and they, everyone looked out for me. And he said one day after high school graduation, there was a kid who had nothing. He was walking down the street and a carload of Nashville high school teachers pulled up alongside him and said, one of the teachers, his favorite teacher, his English teacher, said, "Hey, Lenny, where are you going to college?" And this is a kid that had one shirt between him and his brother for date night, that they had to swap it out. And he said, "I'm not going to college." And the teacher said, "Somebody like you should go to college." So she went back and passed a hat among all the Nashville high school teachers, and they raised $75 of his $100 tuition to Keene State Teachers College. And so he went to, that was it. And they went to the service right after that. And so when he was dying at Mass General about 7 years or so, we're sitting around, and the doctors come in and say, "Sorry, Lenny, there's nothing more we can do for you. You just about 24 to 36 hours left." And he goes, "Darn it, I just wanted 10 more years." And I said, like, that's the attitude I want to have. But he starts barking out commands to my sister and me saying, like, "Pay this and pay that and pay that." And he says, "And you got to pay this girl's tuition." And my sister and I look at each other like, we have a sister that we don't know about? Like, what happened here, Dad? And he goes, "No, the Nashville YMCA, the president of the Nashville YMCA had this teacher in their daycare that they wanted to promote, but they couldn't because she needed a bachelor's degree." And so they came to him and said, "Will you pay for her college?" And he said, "Yeah, absolutely, I'll pay for her college." So, I told that story at his funeral, and the president of my high school was there, and she heard it. And then, a year or so later, she calls me up and says, "Hey, we have this family that, the father was, loves Bishop Girton and always wanted to send all four of his kids there. And he got a pain in his stomach and he kept putting off the pain because he doesn't have health insurance. And, they were Guatemalan immigrants. And he said, finally, he couldn't take it anymore. He went to the hospital and he had stomach cancer and died like 2 weeks later. And she said, "Will you, pay for their tuition if they come in?" And I said, "Yeah, I'll pay it." So, but doing that, I agreed to pay for that family's tuition for all the kids. And I said, I actually said to her, I said, "Wait a minute, you want me to pay for all four?" And he says, "Yeah." So I'll start with the oldest daughter. He goes, "Yeah." She says, "Don't worry, the other three are boys. They probably won't be smart enough to get in." I said, "Oh, you son of a gun. I'll get you for that one." But the teacher, the president came to me, and we've now started a foundation called the Sacred Heart Scholar Foundation, where talk about 20 kids, trying to get 20 kids through the school every year from, inner city kids who could never afford it, like my dad couldn't afford it. And, because we did a study when that school first opened, the cost of tuition represented 4% of the average annual salary of the people in the area. Now it's 20%.
Wow.
So it is unattainable for many of these poor kids like my father was. So now we're the Sacred Heart Scholar Foundation. We're trying to put 20 kids through, and that is going to be my legacy. It's the presidents of the school's legacy as well, and so that is all because some teacher, passed a hat.
That's awesome.
So,
That's a really cool story. Thanks for sharing.
Yeah.
That. Appreciate
So
it.
that's that.
Yeah.
So,
Wow.
I'll send you the video. I had to do a
Please do.
video.
Yeah.
I'll send you the video so you can see it. Yeah, it's a pretty interesting story. My dad was quite a guy. So yeah.
That's
I
cool.
love
So
that.
that's it. Yeah.
Wow.
So that's called kind of real estate investing, guys. That's what you
Yeah.
can do.
That's how powerful
Oh,
it
it's
is.
so guys, you can make such an impact on so much, by getting out there and just, changing what you do every day, a little bit every day can have that kind of an impact. So, yeah.
It's really cool.
So if someone wants to reach out to you because you are a phenomenal human and everyone needs to,
Oh,
I mean, wow.
stop it.
What is the best way that they can get in touch with you?
Really through my website. It's multifamilyinvestingacademy.com or my new website, which is multifamilyos.com.
Okay.
And I've got 3 events coming up, 2 of them open to the public, one of them for all my clients, 3 events coming up, but one of them is a hotel to apartment conversion summit. This is where one of my students is one of the top experts in the country on converting hotels to apartments. And he said 2023 is the year for hotel conversions. Like I just invested in one of his deals. It was a fully renovated hotel that we don't even really have to convert all that much. And we bought it. It's 88 doors, $39,000 per unit.
Wow.
Already fully renovated. It's a home run. And he says these, if you know what to look for, and if you go on those special servicer websites where they're taking they're taking properties back and they're putting them with special servicers, more of the opportunities on the special servicer websites are hospitality sites. Hotels are coming back in droves. And if you know what to look for, you know how to convert them, it's a win-win for everybody.
That's amazing. Yeah. And I'll make sure to put all those links like in the show notes. They will be easily accessible.
Cool.
Yeah. Yay. I mean, wow. Thank you for everything. Like truly blown away. Like this is an episode I'm just going to keep listening to. And I don't usually like to listen to my own voice, but wow.
I know. Yeah. I had to listen to one of my podcasts the other day. I'm like, it's really not that bad. Yeah.
We have to say that to ourselves.
Yes, exactly. Yeah, you do. Sure, nobody else is going to pat you on the back like you can.
Yeah, that's accurate, right?
Yeah.
Yeah.
That's so cool.
But thank you again for joining us. It really was a lot of fun, Charles.
Oh, it was my pleasure. I'll send you over the link for the Sacred Heart Scholar Foundation, and then you can watch the video. You get a kick out of it. You get a kick out of some of the jokes I do ribbing my dearly departed father. So
it'll be lovely.
Hey, it's what I do.
Yeah.
Yes, it is. So
thank you.
All right, guys, great to see you. I have to go take a beautiful girl to dinner tonight. My lovely daughter, she wants to start a business, and so I have to go down and talk to her about the business she wants to start. So It's awesome. It's the best. So all right, I will.
Thank you so much. Well, until next time, explore more adventure ways.